let's talk about partnerships, the middle. And what I mean by that is stuff that happens in between the time a partnership is formed and the time that the partnership is liquidated. So a couple of things can happen. The partnership can make money or it can lose money. The partnership could admit new partners or have partners withdraw. So first, let's look at what happens when the partnership makes money. So remember in the old days when our sole proprietorship made money, it had an income summary account in step 8 of the accounting cycle that had a credit balance. We put all our revenue and all our expenses into that account, and if our revenue exceeded our expenses, it had a credit balance. So we would close it out with a debit to income summary for $22,000 and a credit to owner's capital for $22,000. Owner's capital at the beginning plus net income minus owner's drawings gives us owner's capital at the end. And so now the only difference is instead of one owner, we have multiple owners. So for example, if the partnership had an agreement that the partners would simply split income and losses 50-50, the income summary would still get its debit of $22,000 to clear it out, but each of the partners would get a credit, an increase to their capital account of half of that for $11,000. Of course, it might not be as simple as 50-50. Say Lee and King form a partnership and they have a much more complicated system for allocating the income. For example, they both work in the business, so the first thing that happens is each of them gets a salary. King gets $8,400, Lee gets $6,000. Now these aren't really salaries, they aren't really kind of a paycheck. It's just a term that we use to say that we're going to credit their capital accounts for that amount. Then they decide that each partner will get 10% interest on their beginning capital account balances. And let's say King's had a beginning capital account balance of $28,000 and Lee had a beginning capital account balance of $24,000. And if there's anything left, it gets split 50-50. So we as accountants will prepare a worksheet so we can explain to the partners why their accounts got credited for their specific amounts. We start out with this salary, quote unquote salary. Remember, it isn't really a salary, it's just a term of art referring to the money that's going to get credited to their accounts, reflecting the work that they did. So King gets her $8,400, Lee gets his $6,000 for a total of $14,400. Then we allocate 10% interest on their beginning account balances. King's was $28,000, so 10% of that is $2,800. Lee's was $24,000, so 10% of that is $2,400. So now we take a total. We've allocated $11,200 to King, $8,400 to Lee, so that's a total of $19,600. Since we had a credit balance of $22,000 to allocate, and we've allocated $19,600, that leaves us $2,400 to allocate, and the income ratio is 50-50. So we total these up. Each of them got half that $2,400. And we end up with $12,400 to King and $9,600 for Lee. So the journal entry is the debit to income summary just like before, but they split the $22,000 with $12,400 going into King's capital account and $9,600 going into Lee's capital account. Now let's change up the facts just a little bit. We're still going to respect the priority of this system, but let's say they made $18,000 instead of $22,000. So the salary allowances are the same, the 10% interest is the same, but now our total that we've allocated is this $19,600, and there was only $18,000 to allocate in the first place. So we've over allocated by $1,600. What's the income ratio? 50-50. So they're going to split that by quote unquote giving back $800 each. So they give back $800 each. That's a total of $1,600, which means that our total has gone from the $19,600 over allocated down to the $18,000 we're supposed to allocate. So King's account's going to go up by $10,400. Lee's account's going to go up by $7,600. Okay, the other basic thing that can happen while the partnership is ongoing is we can admit a new partner or an old partner can leave. So suppose A and B are running this partnership. They each have capital accounts of $100,000, and C meets B at a coffee shop and says, I want to buy your interest, and he writes him a personal check for X dollars. He buys B's interest. All we're going to do is change the title on this account to C capital. There's no new assets or liabilities being added to the partnership. That's a transaction between those individuals. Now suppose C instead comes to the partnership and says, I want to put in $100,000 and I want to be a 1/3 owner. That also is pretty simple. C puts in $100,000 cash, so we debit cash for the partnership for $100,000, and we credit his account, his brand new capital account called C Capital for $100,000, and as you can see, he becomes a 1/3 interest, a 1/3 owner. So the only tricky part is when a new partner puts in a certain amount of money that would make him or her a certain percentage owner, and they're going to get either a higher percentage or a lower percentage. So let's do a quick example where things are going poorly. The partnership needs C, and C says, I'll put in $100,000, but I want to become a half owner. Well, once he puts in $100,000, the net worth down here is going to be $300,000. 100 plus 100 plus 100 is 300. He wants to be a half owner, so we have to give him a capital account balance of 150. This journal entry doesn't balance, so what we're going to have to do is pay him a bonus and penalize the existing partners. Let's assume their income ratio is 50-50, so each of them is going to eat $25,000 of this difference. So now after this journal entry, sure enough, the total down here is $300,000, and half of that belongs to C. A and B have had their capital accounts reduced. So that's a bonus to the incoming partner. So now let's talk about a minute a partner with a bonus to the existing partner. So this partnership's going along pretty well. And so C says, I want to put in $100,000 and become a 3rd owner. And they say, no. We're doing great without you, but we will let you in for $100,000, but you become a 25% owner instead of a 33% owner. Well, first of all, one thing we could do is we could say, well, maybe we should write up our assets to reflect their true value, or maybe we should stick some goodwill over there, and we might do that in a more advanced accounting class. But for now, we're just going to futz around here with the capital accounts, and we're going to give a bonus to the existing partners. So once this guy puts in his $100,000, the total down here in the lower right-hand corner is going to be a total of $300,000. 1/4 of $300,000 is $75,000. So that journal entry doesn't balance. It's off by $25,000. If these guys have an income ratio of 50-50, they're going to split that $25,000 between them. So with that bonus to the existing partners, their capital accounts go up by $12,500 each. And we still have the same exact total down here, which is the $300,000. And if a partner withdraws, it's all the same stuff, just in reverse. For example, 2 partners could meet at a Starbucks, and I could offer to buy the other partner's interest. It doesn't matter how big the check is. It's a personal transaction between us. I go back to the partnership and say, hey, take partner B's capital account and move it over into my capital account. Or there could be a bonus to the remaining partners, just like we talked about when we admit a new partner, or it could be a bonus to the withdrawing partners, just like we talked about. These two are just going to involve an adjustment to the capital accounts. So when partnerships are transacting business, there's a couple things that can happen. There's income or loss that needs to be allocated to the partners. That's based on the income ratio, or maybe a much more complicated formula around the income ratio. And then there's also the notion of partners coming in and going out, and that may involve bonuses to the existing partners or bonuses to the incoming partners. I hope that helps.